So it's my pleasure to welcome today's expert, Anders Sjunnesson, co-founder and CEO of Pepicon, which is a fundraising and investor relations platform. Anders is a serial entrepreneur, and he built billion-dollar companies and invested privately in private companies for the last 30 years, have M&A and acquisition experience, and basically the whole shebang. So very happy to have you here, Anders, to share your experience and leaving the floor to you. Thanks for joining.
Thank you very much. Happy to be here. So I hope you can see my screen now. Okay, great. Whoops, that didn't work that well. All right, you gave a short introduction just to give you some flavor on that. I started my entrepreneurial career very, very early. I was actually founding an investment bank called Aragon Securities when I was only 22. We were 10 people leaving a bank and starting that in the mid-80s before stocks became sort of an everyday product for people. I soon left there to start another company called Org Software that became the world leader in derivative system that banks use all over the world to trade. So it was super early in that career, and one should remember when I started investing in unlisted companies or in private companies, we didn't have that market in Sweden at all. In the early 90s, we didn't have one venture capitalist in Sweden, so it was kind of lonely to invest in unlisted securities. So I think it's kind of you do it because you love entrepreneurship and see good ideas become reality, and that's I think was what drove me to do that. So I've done both these things. I've started now maybe 15 companies. The latest one before Pepicon was that I started Pepins, the crowdfunding investment bank, in 2015. So I got both those sides, but I've also been in between. I've been heading corporate finance department for investment banks and on my own, doing deals with everything from the best American venture capitalists to the general public in IPOs, etc. So I guess I've seen everything. I've done all the faults you can do in fundraising and running a business, but also been kind of lucky to have some real successes along the way. So the latest thing then that I started is Pepicon, and that is because I feel that, I mean, this whole industry is not adapting to the digital technology and the tools that should be available now. It's still analog and very ad hoc, this market, and I thought that someone must try to build a system that connects the pieces and makes it much simpler to fundraise, exit, and entertain your shareholders. So we're going to go through, I think it's super important to understand the how it is for the investors and the entrepreneurs and also the middlemen, just to lay a foundation for what we need to do when we actually fundraise. So if we start with the investors, me myself, I even though I'm not sort of raising a flag saying that I'm investing, I have another job. I do investments, but I still receive 200 proposals every year. How can I manage this? It's almost impossible. And looking at the investor's view, everybody says the same thing. We get so many pitches. Nothing is investable when it comes. We receive a pitch text. There's so much missing. We can't say yes or no to anything. And I mean, to go through the work, to do the due diligence and sort of meet these people over and over again, it just takes a lot of time. And I mean, if you take some of the really big VCs, they receive like 4,000 or 5,000 proposals every year. So you can imagine the difficulty being on top, being top of mind when talking to them. I mean, some of them say straight out that we don't even look at most of it because it's too much work just to find the good ones amongst all these companies. So what do I have to do here, or what are my options? Either I can invest carelessly, I can invest in something because I think it's a good team, but I don't have all the information, so I take a chance, right? My other option is to put down all this work to actually get all the information, meet the team, do all these meetings, negotiate, etc. But it's not sensible if I'm not willing to make a very big investment. And that leads us to the ticket size equation that I call it, and that is twofold. One is, I mean, if I am an investor, a reasonably big investor, but very small when it comes to building a portfolio of unlisted securities, let's say that you have a ticket size of 500,000 kroner, and I need to make 20 investments like that. So I need 10 million and then another 10 to fill it up the next round. That's 20 million, and this should be like maybe 10% of my portfolio. Then I need 200 million for investments. So it's not many people where it's sensible to actually make those investments. So for me, it's a lot about getting down the workload that I need to do to actually make that investment. So what can I do then? Either I ask the companies that I only invest in things that are investable from the beginning when they come, or I can piggyback on someone else that I trust. And I think that is a common thing, that it's always most difficult to find the lead investor that others should believe in. And this is actually the reason for that, because it's too much work. It doesn't make sense to actually look at it if you're not an enthusiast like myself in some cases. But then I should only invest in things where I have domain expertise, so I know exactly what it is, right? And then it comes to the next thing. I mean, all entrepreneurs, I think, they are looking for someone that can contribute with something else. So what am I committing to here except putting in my money? Am I committing to spending a lot of time with it? Am I committing to investing in the next round? So it's super difficult. And the last thing I want to say on this picture is that if you go to a professional investor, they need 10 to 50x to actually make sense to invest in reasonably early stage companies. So what is the conclusion of all this? Their problem is actually yours, because you need to tackle these things. If you're going to be able to get investments from these investors, you need to tackle these problems. So you need to make it easy for them to actually say yes or no. Looking at the entrepreneur then, I guess a lot of you have been through this, that it takes a decent amount of time, and maybe more importantly, it takes focus away from your everyday business. And I mean, entrepreneurs that I meet, I think they don't have enough context. They don't know exactly which way to go. So it's a lot of question marks here. And then when it comes to managing in the funding round, I think, I mean, to be honest, most entrepreneurs are not that good in that part, on that part. And the next thing, life or death, that with that I'm meaning that for us as entrepreneurs, it is often a matter of life and death that we get the funding, but it's never a question of life or death for the investor. They have all the time in the world. We need the money now to actually pursue our dreams, right? And of course, there's no best practice that sort of goes over both sides in this. So then one can ask, how do people do when they fundraise? It's a lot of text here. I'm not going to go through it, but for anyone that needs the deck afterwards, you can read it. But most people, they send out the pitch deck. What then? Do they know who has opened this pitch deck? How much time have they spent on it? When is the right time to call again? Is it the right investor? Just because they agreed to a meeting, do I fit their criteria, etc.? So you spend so much time without knowing if you are pitching to the right people. And that leads to, you have to feed these investors with new information, new meetings, and after a while, they are not in sync. And they can only, I mean, you as an entrepreneur, you can probably not handle more than maybe 5 or maximum 10 at the same time. But you cannot keep them in sync if you don't have a very good management of these investors, where you can maybe track if they open documents, etc., etc. And then we come into this overestimation, because if you talk to investors, or to entrepreneurs, you go to a VC and you come back from there and say, oh, this is 50% chance that they will invest. That's in your head, but probably in the investor's head, it's maybe 2. I mean, they meet so much people, and before it's actually a deal, most fall through, right? And then, of course, it takes time. And the last thing I want to say here that is so super important, that if you go down this route, you will be in the worst negotiating position that you can imagine. Because if one of these investors are long before the others and they put the money on the table, you are probably very exhausted and you are not a very good negotiator in that situation. So this sums this up. It's a very uncertain process, and it costs a lot of money, and you're probably going to be very frustrated after some time. So what I would say that it's a disconnect between these two, and we need to do something about it, and that is what Pepicon is all about. So this was a little in-betweeny picture, but I think it shows the conclusion of all this, that in media, it's so easy. There's so much money out there. So it should be very easy to get the money. I would get a very high valuation, but when the push comes to show, if you're not sort of getting dumb money or people not doing their homework, it is not that easy. And for the investors, there's a lot of investors that have seen these oversized returns in the private markets. But when they're going to invest, it's not easy either, because then they see all the problems with the companies. So I would say that, yeah, this is a tricky situation that we need to tackle in some way. And then when we come to the middleman, because I mean, you could get an investment bank or someone like that to help you probably. So there's a lot of people around that could actually help you raise money. But why don't they then? I mean, if you are within an investment bank, you have also all this deal flow. You will pick the one where you feel that the probability to actually succeed is good enough, and the return is good enough on that. But if you get a very early company, hard to evaluate, you don't know what the investors will say, you probably are very, very careful before you take on a deal like that. Then, of course, you have all the friends. And I think many entrepreneurs that I meet, they say that I don't have the network, etc. I think they have a much better network It's much stronger than they think. But the problem is, how do I mobilize that network? Not only the direct investors, but the friends of the investors, etc. How can you manage that? And the problem for them is, I mean, if they're going to introduce you to new investors, they have a different kind of mindset. For them, it's risk, it's downside, it's reputation risk, it's network risk. So you need to make it easy for them as well to help you without and sort of mitigate that risk for them. And of course, most people don't like asking people for money or recommending something without having something in return. And I think that is just human nature. And you need to keep that in mind when you ask people to introduce you to new investors. They might say it just to be nice to you, but I don't think they will put down that much time if you don't have made it easy, taken away risk for them and made them feel comfortable in doing so. So, I mean, to put it briefly, what's in it for them, and that is on both sides, both upside and downside. Just some short things to just give the last piece of when it comes to the environment that we're in. We have all this capital in the marketplace looking for investments, and the stock market is sort of expensive. We see these oversized returns in the private sector. So it's a lot of capital looking for investments. At the same time, it's never been easier to start a company than today. But the competition is harder, of course, since there are so many players out there doing it. We see people going later and later to the exchange for companies. In Sweden, we have these smaller markets, NGM and First North, etc. But in other countries, it's not that so. It's not that much so. So, I mean, looking at it in the US, people go much, much later to the exchange, and the majority of the sort of, to be on the journey where the growth is the most, you need to go in before the IPO. And then, of course, today it's very, very difficult to build a big company without external funding. In Sweden, we had a different environment earlier where we could actually grow organically. But let's take a Voi, for example. Could they build a market-leading position without external capital? It would not be possible. Someone else will take their place if they don't raise capital. And of course, we have no standard. So it's so we are seeing a private company boom. We are seeing fierce competition both for money, but also for investments in these companies. But I would say in that sentence as well that many, many investors are looking for this very narrow niche, and they run after the same things. If you're outside that, I think it's much more difficult to raise money from these bigger players, at least. Again, we need someone to do this. So coming into the fundraising in itself, this is the first question one needs to ask oneself when you are thinking about raising money. Why am I doing this? Am I realizing, do I want to realize an idea? Do I want to get rich quick, or am I after something else? Just to understand the next question, do I even want external investors? How many? Who should that be? Everything comes at the price, and external investors very much so. It's something totally different to run your own business. Maybe you have some friends and family that have invested, very friendly investors, understanding and liking you as an individual. But once you bring in external investors, things can be quite different. It's a totally different kind of pressure. So we just put down some things here, but I mean, entrepreneurship goes up and down. You need investors that understand the journey that they're on, and you need to be very good at telling them how that journey looks like, even before they invest. You don't want investors that don't have the patience, because it will go up and down. And these people who have invested a little bit more than they should and have not really understood what they have invested in, they are the worst investors you can have, because they will ask for the money, the color of their money, much too early, when you are still on your journey to your dreams, or try to realize your dream or your vision. So really be careful when choosing investors, and choose the ones that have done their own work. And then, of course, you have all the formalities and shareholders agreements, etc., etc. So when, let's say we have decided that we should raise capital, then we can start sorting already before we do. Do I want the VC? Am I ready to ride the bullet, as I call it? Are you prepared to be locked in, which you will be with one of these guys? And it's a go big or go home style of investor. Can be very good if you are that kind of company, because they will help you a lot. They have amounts of contacts. They know how to raise the next big round together with other syndicate partners. So in that case, it's fantastic. But for you as a private individual, it's often you are betting the whole thing. There's nothing taking it slow and careful if you invest with these guys. They want to get the 50 to 100x or something like that. And you need to be willing to place your bet, all that you have. And of course, then you need to give up power. They won't let you do anything with this company. They will have veto rights, etc., for a lot of things in this. So here you can start picking angels. There are so many different kinds, so it's impossible to set one framework. You have everything from those who just want to contribute and put in a little bit of money, and you have the angels that are quite big, haven't done big exits in other companies as well. But it's nothing saying that the one with the deep pockets contributes more when it comes to the actual business. It might not be that important for him. Then you have the investment organizers, of course. That can be an investment bank or a crowdfunding platform or an angels club or any kind of investment club. Family offices, of course, and then you have the private individuals. Then I think you should think about what kind of investor do I want? Do I want someone who sits in the back seat or someone that is more active that can actually help me? Am I ready to give away influence, or do I want to run this company exactly as my own head tells me? And looking for things that might help a company, depending on your team and what you think is missing. It might be that you want a domain expert in some area, maybe in your own field, or it can be a subsection of what you actually need in the company. It could be marketing or something like that. But I think it's important to think that through before you actually start the round. And then, of course, do I want an investor that have a portfolio of multiple investors that maybe is easier for him to take a hit if it doesn't go well? Or do I choose one that have only a few, maybe an amateur investor? On the other hand, the investment might be more important to that guy, that he puts down more effort and more time into helping your company. And then, of course, one must see that it's aligned the investment horizon with the one that you are targeting. Otherwise, you should not spend the time on it. And that is why this picture is so important, because people spend time on deals that are dead from the beginning. It's not a fit. So you need to know what is a fit to spend your time on the right ones. And of course, it differs as well when it comes to rates of return. Some people are, I mean, looking at the VCs, they are on the extreme side maybe. Private individuals is I think, less so. Now we come back to the problem scenario that I feel that, and I think I've spoken to most big investors, or both big and small now in both Sweden and Europe, and everybody says the same thing. 99% of the companies that come here, they are not investable in the way they present themselves. 99%. And it's not because it's bad companies or a bad team, because that is sort of the first thing that you need to tick off, right? No, it's because there's not enough information for the investor to say yes or no. They need to put down a lot of work to be able to do that. So, and they're probably in the same situation as I am. If I find something that I feel is a little bit quirky or something, I would say no. I'm not giving them the chance because I need to sort out and try to find the ones that I'm willing to spend time on. So what should we aim for then? We should try to be fundable at all times. And I think what we want to achieve when we start the process, or the goal should be that we need to do this in a speedy fashion. And I'm going to come back to why we need to do that. We should have an investment case that we can present to the investors so we are aligned what they are getting themselves into. We should not only ask for the money, we need them to understand the journey that they're on. We should see that their interest and time horizon is aligned with ours. And of course, as I told you before, we should make sure that we are not getting the wrong investors on board. And we want a fair valuation and fair terms, right? And to do this, we need to be investable. We need to provide the information that the investor needs to say yes or no. Otherwise, we will get maybes and a lot of yeses that they are not yeses until you actually get their name on the paper. When we were running, sorry.
We have 15 minutes left of the presentation.
15 minutes, perfect. I will do that. I mean, for example, in my earlier job here at Pepins, it was so many companies coming to us saying, "Oh, we have 50% of the share issue already covered." And then you ask them, "So what was the terms? Price? What was the price of the valuation of the company? Where is the shareholders agreement?" And when they say, "Oh, but it's not really set, but they will invest 50%. That is just bullshit, right? It's not a yes. It's not a yes until you ticked all the boxes. And most of this will drop off when they see that they are not getting the board position or the vetoes that they want, or a valuation that cannot be justified. So being investable means also other things that is super interesting here, because if you are ready, you can close the deal at any time. You can even close before you open the round. But if you have nothing on the shelves, you can't, right? Then if you are ready but not open, you can start nurturing and actually sort out the ones that are interesting. It's much more comfortable to come to an investor and say that I'm preparing a round, I have not decided on the terms yet, but I would like your feedback. And it's cool for the investor as well, because there's no pressure on them coming back with the result or something like that. But you will know who to target once it's done. If you're lucky, one of these already from the beginning will say that I'm prepared to go into a discussion and help you set the terms and take the lead in this without having the round open. So we are qualifying the investors in that. And I think this one goes for everything, and it goes back to what I said before, that you need to have a strong negotiating position. And if the investors feel that we are not in a hurry, there's no one else taking this deal in front of us or something like that, you can't achieve the speed that you want in the fundraise. And being investable also gives you all the flexibility you need. So you can go to a third party and get their help, or you can go to strategic investors, or you can go to angels. You can choose a multiple route here, as long as you know that you have something on the shelf that actually can give you yes or no. And if one way doesn't work, you have all the reason in the world to go to someone else without sort of doing it all over again and warm people up. And I mean, it's simple. Always have something on the shelf. It's like if you're selling milk, you don't want to say to the customer that I need to go out and milk the cow first, right? That will scare them away. And I mean, if you can stay investable over time, you can actually take the opportunity on the fly when it comes. It can be an exit or a merger or a strategic investor that you really want. But if you're not there with the material, you need to take the decision. Do I take my management team and put together all this information again and make them lose focus all again over again without me knowing that we're going to do a deal or not?
Anders?
Yeah.
What if I don't know how many rounds we're gonna do? Like if my initial assumption is that like this is gonna be our final round, then we're gonna be profitable, we're gonna grow organically, or like how do one like manage the trade-off of admin effort to stay fundable versus executing on other things?
But staying fundable is like keeping your things in order, keeping the relationships with your stakeholders, both the current investors and the ones that have said that maybe in a later round, etc. It's not that much work. It's more. I mean, if you have a data room, you should probably not shut it down when you have done the deal. You should keep it open and keep it ready. And I think we never know as entrepreneurs how much exactly it will take until we reach our goal, right? So I think trying to be transparent, the investors are not stupid. Most investors don't believe in the budgets that you are showing them anyway. I think it's if you have done some investments, you know that it's rare that the company hit the target that they say the first time you meet them. Oh, so what I'm saying is start early, but don't open the round until you almost know that you're going to close it within 30 days. It's much better to have something that you are ready, you have all the material there, but you don't open it officially and try to raise the money, because then if you're not hitting that target, people will get scared off and drop off. And that is the worst thing you can have, because then you need to go back to the other investors that say that this investor that I had, now he left it, and then you need to start over again. So start early, but don't open. Make it easy for the investors. I think that message has come through already. And then everybody's talking about the pitch and the team. They are fundamentals, of course, but it's not enough for a yes or no. You need that. That is sort of the entrance door. If you're not ticking off that box, you're not getting in the door anyway. So it's a build-up. I've said it before. Sense of urgency is super important. Keep the momentum. Make sure you have resources once you really start to push the momentum and to gain this negotiating position. You need not one investor. You need a couple of investors at least if you're going to be in that position. Otherwise, you will be weak. And of course, a lot of investors ask for exclusivity, etc. Exclusivity should, in my mind, only be given for a confirmative due diligence.
What do you mean with conservative due diligence? That
Confirmative due diligence, that you have presented the information. They've said that we are willing to do this deal. This is the terms, but we want to check so everything is right, what you have said.
Okay, so basically all preliminary yes.
It is a yes. If they're going to say no, they need to find something in the due diligence that is not true, that you have said. And otherwise, they are bound by the deal.
Got it. In exchange for exclusivity.
Yes. I mean, it's again, the negotiating position, once you have done that without having a firm commitment from their side, it's not a place you want to be in. Okay. Then let's talk a little bit about third parties. I'm going to flip up the next one as well. Third parties can be extremely valuable, especially if you run out of potential investors yourself, or you have too few to get in the position that you want to. But you need to make it simple for them, as I said as well. So if you have a material that is ready, where they don't need to put down that much work to actually vet your proposal, you make it super simple for them. They already have the investor contacts. For them to introduce you to investors and get a kickback from that is super interesting, I think, for many companies, and a route that very few is taking, I think. Then staying top of mind is always difficult if you go around with the pitch deck and you hope that they have read it. But how do you sort of come with news to all investors at the same time? You need to find a way, get their phone numbers, make an mess list or something like that, so you can remind them of your company. Save a few news items for that kind of activities. So, for example, if you know that you're going to recruit a new CEO, or if you're going to land a new customer, maybe you could save some of those news just to keep keep it boiling and a reason for contacting them again, instead of just asking if they have read your material. Dedicated resources, we said lead investors is always a big thing. I think it's very difficult to go out to too many investors before you have set the terms. You need, if you are spreading, let's say that you want 30 investors, you need to find the first 3 or 1 if it's a big one first. So you set the valuation of the company, you set the shareholders agreement and everything like that. Otherwise, it's you can't negotiate with 10 or 20 people at the same time.
I have 5 minutes left for the
5 minutes
presentation.
left, okay. Then I'm actually going to skip that one because I think I've covered that.
Can I just ask you regarding, or
Yep.
I'll save it for the Q&A, by the way.
Okay. Then what happens then? I mean, when you have raised the money, your next funding round or liquidity event starts immediately. I mean, as soon as you stop selling your stock or sort of justifying the value of it, if you're not keeping that up, it will actually go down. And I think I've gone through all the things why you should keep investment ready, but it's also a way to keep your shareholders happy and the network around you happy. Even if you have a bad time, if you keep them close, you are transparent, they will have a much better understanding for your situation. Putting your head down in the sand and keep them in the dark, that is synonymous with them not investing any money in your company the next time. And I know how difficult it can be when you have a disappointing quarter or year or whatever, to actually face the investors to say that, hey, it didn't go as I imagined. That is a tough one to come back after a year and saying that without having said anything in between. It's much easier for them to understand if you keep them informed over time. So I think this can be the last slide, so I pick my last 2 minutes. Liquidity. You can say that your companies are not liquid at all, okay? But the continuous ability to raise funds, exit, or trade means a higher valuation. One should keep that in mind. And if you keep your company investable, it's actually possible for investors to sell share. Of course, you need to follow the shareholders agreement, etc. But if you have an investor that maybe you don't want on the team anymore, it's perfect to have that. You can actually trade that. And then again, if the opportunity arises, you are closer to the next round or the next valuation or whatever, if you stay as liquid as possible, even though knowing that private companies are quite illiquid. And this is the question I think all investors are asking: when and how will I see the color of my money? And I think for me, just to finish this off, one of the most overlooked criteria for investors is, do I think this company can raise money again that is not my money? Can they raise from someone else? Otherwise, I will be held hostage in this company, but I don't want to. Okay, I think that finishes. Yeah, this is just a circle of life. You can have almost what I have discussed here. You come ready, you manage the round, and then you take care of your investors and other stakeholders. All right. 40 seconds.
Awesome. Thank you so much, Anders. That was really insightful. Before we start the Q&A, Kat, do you want to trigger the survey, feedback survey? And while we're doing that, feel free to jump in, anyone with a question to Anders. Okay, then I'll start. You mentioned, Anders, quickly on the part of the beginning in terms of like you can track when investors are looking at your deck and what they're looking at. I've heard in some investor circles that they really hate when people are staring over their shoulder about what they're reading and when and how. What's your take on that?
I think you need to be somewhere in between. You have, I mean, when I was doing this like 10, 15 years ago, we did this WeTransfer, and at least you could see that they have downloaded your deck, right? So, I mean, that I don't think anyone is thinking that is something that they can't live with. But then you have these, I don't know what those companies are called in one word, but these Google Docs like things where you can see every detail they are looking at. And I think that is annoying for the investors. So you need to keep it. I mean, if you can read if they have opened the mail, how much time they have spent on looking at your pitch deck, that is enough for you. You don't need to have more information than that. You just want to see where is it worth to take a meeting, and where is it not. Who are ready for the next call.
Yep, that makes sense. When it comes to, I'm gonna just keep going until someone jumps in.
I
Niklas.
can jump in if you'd like.
Okay, go for it. I'll pause my questions.
Okay,
go for it,
great. So thank you, Anders, and thank you for opening with a statement that your industry is not adapting to the digital world. I'm in the same situation with my company, but I have a question regarding bridge financing.
Yep.
And your experience of that, and what to think about if you are between round 1 and 2, and how would you think about bridge financing, and what traps are there, and what to think about if you are about to push a bit because you have a good momentum in when it comes to customer revenue build up, so to say.
Well, I think it all depends on what kind of bridge funding we are talking about. I mean, if you can get a bank loan or so, that is obviously the cheapest money that you can get. I mean, the investors' money is the most expensive money you can get. One must remember that. When it comes to this equity, what shall I call them? The ones that borrows money to SaaS companies towards against a piece of the action, so to say, without being shareholders. That is a more delicate, I think, situation. Then you must know that you can pay it off that way. Otherwise, it can be a poison pill for the next investors. So, I mean, those are two extremes, I would say. And then, of course, you have the ones that take ridiculously much interest just to lend you the money. But I think one can talk about the cold water of debt and the warm blood of equity. That is true as well, because it gives you space to actually focus on your business instead of just paying off your debt, right? So I think it's a trade-off, but sometimes you just don't have time and it's too expensive to especially if you feel that I know that my company is worth much more than the investors are willing to pay today. I know what's going to happen, but they won't believe it until they see it. Then, of course, every other route to finance the in-between period is worth it, probably.
Okay, great, thank you.
Niklas.
Thank you. And thank you, Anders, for sharing such useful insights. I'm Niklas from Deedster. I have a question around one of the many difficult things being financial projections. And you said they don't believe it anyway. So how should I think about projections? Should I be super bold or should I be more conservative? I think it's very difficult to strike the right balance. Do you have some advice?
It is a very difficult thing, and I think different investors have a different view on this. I had one of the big US investors in an earlier venture. They said always under promise and over deliver, and we will compensate for that going forward. But then again, they want to negotiate, right? So I think you need to be as true to your vision as you can, and then of course you can have a low case and a high case scenario, I guess.
So did you keep a set of projections in your pocket? So going to the US, you had the really bold ones, and going to Stockholm, you had the really boring ones.
No, I normally use 3 at the same time, because and it also depends on what you want to achieve from the vision with your company. Let's say that you are a company that wants to create a new standard, for example. It is what does it cost? How long time does it take to go there? That is more important than the revenue itself, right?
Yeah.
So in that case, you should try to convince the investors it's not about our revenue the first couple of years. It's about taking the market. So I think it all depends on what kind of company you are. I don't know if that was an answer.
That was great. I have one more, if that's fine, Sebastian. Okay.
Yeah,
So
sure.
I think like closing one lead investor, sort of when you're still not open, is a really good idea. And close the terms, and then you said go and fetch the rest and negotiate. But what can possibly be negotiable technically when you close with one?
It's not. That's what I'm saying. It's when you have closed with one, it's so much simpler.
Yeah.
You are making life simpler for the other ones. Either they take it or they leave it, right?
Yeah.
The only thing you can negotiate is who should be on the board if you have some places left in the shareholders agreement for other investors.
Right. Excellent. Thank you very much.
Good question, Niklas. Stephen, looks like you want to ask something.
No, I was taken with the whole sort of SaaS ARR loan thing, that your view on that. But as you point out, there's a risk in terms of poison pill for the next round.
Yeah. I mean, I can take questions. Otherwise, I have another one that I didn't cover. I thought it was going to be too long, but of course, what we have to take in consideration when we do the funding and valuations and terms, etc., it is the type of security that we are actually issuing. Are we issuing preference shares, or what type of preference shares, or are there common shares, etc.? It affects the valuation dramatically. I mean, I have the example with Airbnb. They did a preference share round where the investors were guaranteed 2.8 times their investment before anyone else got one single penny. And then the papers write that they get this fantastic valuation of the company, but that's not for the common shares, right? And that is also a decision that one needs to take, I think, when you decide on who should invest. Because if you look at the big VC rounds, it's especially in the States, is I would say 90% preference shares.
Yeah. Anyone wanna? Victor, go for it.
Yeah, hi. I was a little bit late in the workshop, but you were talking about this to get help from third parties, and it's a lot of them out there.
Yep.
So how do you know that it's like a good partner to go with?
Well, I mean, as I understand from you, Sebastian, the type of stage the companies that are in this workshop, I think it's not about giving someone exclusivity in your face. I mean, you are the manager of your round. You are your own investment bank, and then you can get help of others to help you raise an additional or part of the round. But I think. Of course, you can go to one if you're ready to pay, but But in this context, I'm more seeing that you are managing the round yourself, and there are third parties that have the investor contacts already. So can you take risk away from them, make it easy for them to approach other investors? It's kind of easy money for them to help you.
I can chime in on this. Annika here from Dramatify. We've been approached by a number of third parties, and I would say you have basically three categories: the serious, good ones with where you can track them. They have long experience. They may have a fantastic CV on LinkedIn. They seem sensible and nice. And then you have the guys who's in it for the money and requires a lot of money up front, and that can be like 20,000 to 30,000 euros before they even get started, and then it's a success fee on top of that.
Yes.
And then the third part, which I actually experienced the other month, a complete scammer. And I felt during the call, this is something weird. So I started Googling, and he was arrested for battery, marijuana, and had sort of people writing on a forum that this is a complete scammer. Not within investment, he had done some kind of mission. So, I mean, Google people, there's a lot of people that want your money. So thanks. Oh, and by the way, fantastic workshop. Thank you very much, Anders.
Thanks, Annika, and for sharing your experience. Like, there are some scammers out there, so
absolutely. But you don't take on investors if you don't meet them, right? I mean, what I'm talking about here is someone helping you to get the introductions. You choose them yourself, of course. But for me, I mean, some of these companies that you mentioned, they are probably very good. They do all the work for you, the valuation, the memorandum, or whatever they use, and they help you all the way. But then you need to pay them, of course, and you need to pay them up front. And there you should be very careful who you work with, because there's a lot of people that can do a nice pitch deck and some prep work, but it's another thing bringing in the money.
Yep. We just hit 3 p.m. so time's up this time around. Anders, again, really appreciate you taking time out of your busy schedule, sharing your experience with us. Thanks everyone for tuning in. We will announce soon for the next workshop. It will be startup finance, I guess. I think we'll see. We'll let you know what's the next upcoming workshop, and also stay tuned if you want to hear more about fundraising. Me and Anders gonna jump on socials and have a fireside chat in a couple of minutes. That's it. Thanks everyone. Have a great day.
Okay. Thank you.
Thanks.
Bye.
Thank you.